Welcome, everyone, to our 22nd annual GHPIA Economic Forum. Normally, this is the moment where we pause for everyone to take their seats and finish their table discussions. Although we really miss being in your physical company for this event, we are gaining confidence that next year we will be back to our normal lunch or evening cocktail format. We've also adapted and will always provide a digital simulcast of these events going forward. I am Mike Sullivan, a partner with GHP Investment Advisors and one of the wealth management advisors with our firm. I joined GHPIA in early 2008, inauspiciously timed with the onset of the great financial crisis, a time when I learned the meaning of the phrase, out of the frying pan and into the fire. After yet another episode last year, where we all endured personal adversities and portfolio setbacks, we of course want to thank you for your patience and adherence with our firm's investment guidance. Importantly, we want to use our time together today to weigh the ongoing risks your portfolios confront, but leave you with a firm grasp on the many positive developments in the US economy and equity markets 15 months into this pandemic. Our format today will begin with 10 minutes of videos, followed by about 30 minutes of live presentation from our esteemed wealth management advisory panelists. And then we'll wrap up with 20 minutes of Q&A using the questions you have submitted this month. As part of our transition to our spanking new office this year, we wanted to begin with a video for you all to see not only our new digs, but also to get to know more intimately our growing team of 25 and their respective departments. We will also include one of our recent pieces from our new video series highlighting our investment selection process. This clip is about our proprietary profit stability score. I will be back with you in 10 minutes to introduce our panelists. So thanks for tuning in. It's truly our pleasure to have you with us today, and we look forward to being with you in person again soon. Give me a moment and I'll cue up the video. And I want to just mention, our tech team has said we might want to have you turn up your volume, at least for the beginning of this first video. At GHP Investment Advisors, we are always planning for the long term. That's why in 2020, in the midst of the pandemic and the shutdowns, we went ahead with our expansion plans. We set up a new, more inviting office here on Capitol Hill in the heart of Denver. And we added to our team to continue to provide our growing base of clients the level of service they deserve. Today, we are proud to invite you into our new space and to introduce you to the whole team. Come on up.
When GHP Investment Advisors began 25 years ago, our concept was a more holistic approach to wealth management. Our services encompassed our clients' entire financial picture, from financial planning to portfolio management, taxes, retirement, estate planning, education funding, charitable giving, all of it. But there was only a handful of us here back then, and each of us had to wear many hats. Since then, however, we've added experts and specialists who learned from our clients' needs and how they can use their skills and knowledge to address those needs. So our departments developed organically to offer solutions to the issues our clients face.
When I came to GHPIA, I still had much to learn about the major disciplines of wealth management, such as quantitative financial modeling, investment management, income tax, estate planning, risk management, education, and business analysis. Not only did I learn all those, but I helped integrate them into the services we provide. Today, I am the lead advisor for many of our clients. I take pride that I have played a key role in GHPIA's evolution.
My background as an advisor with this firm is first as an investment analyst and financial planner. I'm accustomed to thinking of market and economic cycles as occurring over long waves, but my clients have concerns about what's happening in the market now. So it's also my job to provide historical context to broaden their perspective as well as relate our financial advice to their emotional and personal stresses. So I see my role as part historian and financial therapist too.
We still wear many hats, but my role is primarily as advisor and financial planner. My experience from the retirement plan industry helps clients navigate that complex landscape, and I use the analytical skills I learned there to advise in other areas like investing, insurance, and tax planning. What separates a competent advisor from an excellent one is identifying areas where clients may not realize they need advice and helping them follow through and implement on our recommendations.
As a CPA in the corporate accounting world, if you would have told me 10 years ago that I would spend my days talking to clients about all aspects of their personal financial lives, I would have thought you were crazy. Now, it is my favorite part of my job. I still manage the compliance and accounting departments at GHPIA, helping to ensure that we follow our regulatory requirements as an SEC-registered investment advisor and act in our clients' interests. I also analyze various financial questions, such as when a client should take Social Security, terminate a life insurance policy, or take deferred compensation.
My department continually monitors the markets and client portfolios. Since every portfolio is unique, we are always checking to make sure your portfolio is in line with your custom financial plan. We try to ensure that your asset allocation is properly balanced and diversified, that your transactions are timed with tax impact in mind while targeting the best risk-adjusted returns. We are discretionary traders, so our clients trust us to make portfolio transactions that are in their best interests. But if clients have questions about the markets, the economy, or particular assets, my team and I are happy to walk them through the way we think about it. Not all advisory firms offer that kind of access.
Our proprietary investment risk scorecard allows our team to quantify risk across different asset classes so we can focus in on investments we believe have the most long-term potential. Even after we buy, we continue to monitor all holdings to make sure they align with our benchmarks. My role is to create and enhance the tools used to screen and monitor investments, as well as to take the necessary deep dives to really understand the companies and industries.
I'm responsible for the day-to-day trading and management of client portfolios, the curation of our buy list, and implementation of our overall investment strategy.
I cover trading, execution, and clearing for the firm. I'm also a member of the investment committee, where I analyze opportunities and risks to help decide which stocks to buy, hold, or sell for client portfolios.
As the client relations manager, I strive to lead our team in providing an above and beyond client experience. Our goal is to be the primary point of contact for all day-to-day financial needs, and our team is also an advocate for our clients when working with their CPAs, estate planning attorneys, or other financial professionals outside of our firm. I look for those aha opportunities that truly show our clients we care and have their best interests in mind.
As a client relations specialist, my goal is to be an effective and educational resource for our clients. Our clients have unique needs, and we take pride in helping them with the issues that are most important to them.
We also take pride in being accessible and personable in all of our interactions with our clients.
As one of clients' first points of contact, I'm here to help with any questions they have, whether that means reaching out to our third-party providers like Charles Schwab or other members of our team. I make sure clients get their concerns taken care of.
I'm the nerve center of the office. I schedule appointments for clients and team members. I'm the phone operator, assist clients with paper and electronic forms, maintain office and kitchen equipment. I'm the first person that clients see when they enter the office, so I make sure that their visits run smoothly and pleasantly.
It's rare for advisory firms to have a CPA on staff to assist clients and team members on tax issues as they arise. I'm happy to serve in this role for GHPIA and to bring my 20 years of tax planning and compliance experience to bear on behalf of our clients and their tax situations.
I'm responsible for keeping the lights on. In other words, I pay the bills and make sure the advisors are paid for the services they provide for you.
We didn't want your dealing with all the particulars of your financial life to get in the way of your life, so we created the unique financial concierge team. This team goes above and beyond traditional financial planning to provide high-touch service and to take everyday financial burdens off your plate. We maintain strong, lifelong relationships with our clients, their families, and their trusted professionals. Clients know that they can rely on us to go above and beyond the services traditional investment advisors provide. And we're glad that we can take care of the day-to-day logistics of their financial lives so that they can have the peace of mind they need to focus on their hopes and goals.
I am a member of the financial planning and financial concierge teams. People often come to me with complex financial planning issues, and I enjoy solving those problems. I like meeting with clients to talk about estate planning, retirement modeling, updating balance sheets, or just catching up on their lives.
At GHPIA, we are always looking to advance our technology tools and design solutions to aid the team in operating at maximum efficiency. We implement services and tools that deliver a one-of-a-kind client experience.
We have many tools, some of which we built ourselves to protect the client's data, track their portfolio holdings and activity, and alert the trading team when individual portfolios may need rebalancing or trades need to be placed. We've automated a lot of the administrative work, which gives advisors more time to focus on client services.
I'm in charge of telling the GHPIA story through every available means, from email and social media to videos like this one. It's a great story, but it's really a story about you, our clients. You face challenges and big emotional decisions, but if you work with GHPIA, you have this amazing team to guide you and walk beside you as you confront these challenges and decisions. It's a good feeling to know that when it matters most, this whole team is here for you.
All right, one more video for everyone. This one is shorter. Nice work, Gary. Thank you. Bear with us. Technical difficulties. I'm the driver, so here we go. There is always a trade-off between the degree of investment risk and long-term investor profits. Our investment strategy quantifies these risk factors so that our clients' portfolios may achieve desired growth while avoiding disasters. Think of a three-lane highway. The slow lane investor risks not accumulating and maintaining enough retirement wealth. The fast lane investor may speed ahead, but risk catastrophe when conditions change. GHPIA seeks the middle lane to achieve the best risk-adjusted investment returns to grow and preserve your wealth. Our team of analysts has developed a highly quantitative investment risk scorecard. Among the many risk scoring metrics calculated by our scoring tool, this video will focus on our profit stability score, which evaluates a company's operating risk. Operating risk involves a firm's exposure to factors that may shrink its profits or lead to bankruptcy. High fixed costs, poor management decisions, and product obsolescence can increase operating risk and reduce profits. Our scoring tool elevates firms with dependable profits over long periods and helps us avoid firms with sporadic profitability or exciting yet unproven business models. Imagine a plain but steady company that makes health products, something people always need, even in lean times. Now imagine a company that sells a flashy luxury tech product. Both might average the same profit over a decade, but the less volatile company will have a higher profit stability score. To long-term investors like us, that stability makes the company a more attractive buy. To calculate a company's profit stability score, we divide its average annual operating profit margins over a given time period by the standard deviation of those annual profit margins. If the score is high compared to its industry competitors or relative to the entire stock market, then our investment team considers that stock a stronger, lower risk prospect. Of course, a profit stability score is only one of several risk scores we calculate as we continue down our investment risk funnel to pinpoint companies we ultimately buy. Our proactive, quantifiable risk scoring technique takes the emotion out of investing and helps us strike the proper balance between risk and reward when we buy stocks. No matter which portfolio selections best fit your personal financial needs and goals, the best long-term strategy helps you avoid both excessive caution and excessive risk. Our profit stability score helps us stay in that middle lane all along the journey. All right, well, thank you for your attention to those videos. Now, for the wealth management panel discussion. I would like to introduce Brian, Reed, Carin, Sebrina, and myself. We titled our presentation today, The Road to Recovery, Should We Change Lanes? Oh my, hang on a second. Clearly, we got to hit stop on YouTube, but I'm a bit of a tech dinosaur, so my apologies. We titled our presentation, The Road to Recovery, Should We Change Lanes? Brian Friedman will kick us off with a summary of the breadth of the equity market, which extends well beyond the popular handful of companies getting most of the media spotlight on CNBC and in the pages of the Wall Street Journal these days. Brian is the co-founder of GHPIA, a University of Chicago MBA, a chartered financial analyst, and a mentor to so many of us. Brian will transition to read McCoy to highlight the fast lane in keeping with the highway analogy, a lane which includes several of those companies and investment vehicles getting most of the media buzz. Reed is a graduate of the University of Minnesota, a certified financial planner, and has deftly transitioned his career from grade school teacher to educator of GHPIA clients for all things financial. Then Carin Wagner will summarize the slow lane in presenting on the bond markets and interest rates. Carin is still quite young, but is a senior partner with GHP Investment Advisors, a certified financial planner, and earned her MBA at the University of Denver. Next up, Sebrina Ivey will speak to us about the unfortunate wreckage off on the highway shoulder in the financial markets during this pandemic. Getting into the alphabet soup a bit here, Sebrina is a CPA and a PFS, which is the equivalent of a CFP earned by credentialed CPAs. And she recently received a distinction from the American Institute of CPAs for the Personal Financial Planning Standing Ovation Award, bestowed only to a small handful of CPAs. I will provide our concluding analysis regarding the middle lane, and then we will move to Q&A.
Thanks, Mike. Mike's being modest. It's true, he started in 2008 in the middle of the last crisis, the financial crisis, and has been with us now for 13 years. But what he didn't say is that along with Carin Wagner and myself, the three of us these days comprise our executive management committee. So Mike is also a senior management executive here at GHP Investment Advisors. And I think you can tell already why. Let me also share my screen and bring up our presentation, assuming all goes well. Mike, Carin, Sebrina, Reed, can everybody see the slides on your end of the, okay. I'm going to set the stage using this 3-lane highway example that many of you have heard us discuss in recent months. It frames a lot of the conversation that we've been having regarding risk and reward, but I'm also going to use it now to frame a bit of the conversation around what I would say is perspective and proportion. I began my career more than 30 years ago in 1989. In 1989, the total value of the United States stock market was just a little bit more than $3 trillion. And the largest company by market value in the United States was Exxon, which at that time was worth $65 billion. That was just a little bit less than 2% of the total value of the United States stock market. Today, the stock markets and the financial markets more generally have grown by immense proportions. Today, global stock markets are worth a collective $112 trillion. I know it's hard to imagine how much a trillion is. It was hard back in the day when I first started to even imagine what a billion was. But as I mentioned, the entire stock market in America was worth $3 trillion. Today, Apple, the largest company by market value, both in the United States and the world, is all by itself worth $2.2 trillion. And if we take the top 2 companies, Apple and Microsoft, those 2 companies alone are worth more than $4 trillion. In other words, 2 companies today are worth more than the entire United States stock market was when I first began my career in 1989. Similarly, Apple by itself makes up more than 4% of the value of the United States stock market, more than double Exxon's proportion back more than 30 years ago. I wanted to start this way just to frame the conversation, because the markets have grown in the United States to a total of $48 trillion. They are more concentrated today, meaning the largest companies make up a larger proportion of the market than they did when I began 3 decades ago. And the top 85 companies, as you might see on this chart, all of which have market values in excess of $100 billion, meaning there are now 85 companies that are almost double the size of what Exxon was many years ago. Those 85 companies make up 50% of total US stock market value. So the stock market today is more concentrated. On the other hand, that concentration does not necessarily mean that there's a narrowing of opportunity. In fact, I often find it interesting when we have these debates, either about the concentration of the stock market, the concentration of the economy, or the concentration of wealth in the United States, that perhaps the way these issues are framed is a little bit different than at least how I think we perceive these issues to be. Because even if we eliminate from our calculation the 50% of the stock market in those large 85 companies, the remainder of the stock market, which comprises nearly 5,000 companies, meaning almost 4,000 of which are smaller than $100 billion. Nonetheless, those companies collectively are worth $24 trillion, 8 times more than the entire value of the stock market in the United States in 1989. The pie perhaps is more concentrated, but it's a much, much bigger pie. Once again, if I go back to 1989, Exxon was not the largest company in the world. There were 3 Japanese banks that were not just bigger by market value than Exxon, they were more than double the size of Exxon's value. Only a few short years later, the Japanese market collapsed, and many of those banks actually teetered on the verge of bankruptcy and insolvency when the Japanese market crashed. Today, the largest companies in the world are American technology stocks, but some of the largest companies in the world are Chinese banks. We're not going to get into the specifics of the Chinese banks, but there is some analogous properties to what Japanese banks were all about more than 30 years ago. Over the last 30 years, there's been a proliferation of media and conversation about a whole variety of topics. We've gone from 3 television channels to many hundreds of cable channels, websites that didn't exist in 1989, Snapchat, Twitter, Facebook, Instagram. None of these media methods of communication existed 30 years ago. Nonetheless, despite the explosion of channels of communication, in many ways, there's been a narrowing of the conversation. When I listen to the media or the conversations that seem to circulate on social media, it's astonishing how narrowly focused on just a handful of companies and situations those conversations tend to be. And they tend to focus on the extremes. There's more conversation about the 7 companies worth more than $500 billion, all 7 of which are information technology companies, than the remaining 4,971 companies that spread across hundreds of industries and sectors in the United States. It's our goal to make sure that we maintain our focus, not just on the biggest, but on the best. As the video said, we want to have the appropriate risk-reward ratio. That may be found amongst those 7 stocks because, in fact, we do have exposure to quite a few of them. But it also can be found among the 2,600 stocks below $1 billion, or the hundreds or thousands of stocks below $15 billion in market value. So when we talk about our middle lane analogy, and we're going to break it down for you in the following presentations, it's important to remember that the stock market and the financial markets more generally are not equal places. They're highly concentrated. And the way that you mitigate risk in a portfolio is through, of course, diversification. We believe in diversification. We want to spread our stock portfolios, our bond portfolios. We want to spread our portfolios across a variety of companies and a variety of industries. If you buy the stock market in its entirety, you have a less diversified portfolio because of this immense concentration in value at the top. If you buy the indexes, the Dow Jones Industrial Average, the S&P 500, you have a less diversified portfolio. If you buy the NASDAQ, you have an even less diversified portfolio. You may do better in terms of return, but you will also increase your risk, and we want to balance all of those factors. Just to bring home the point, if you look at technology, information technology, those stocks comprise almost 30% of total stock market value in the United States. We like that sector, we certainly do. But just so you get a sense of proportion, the technology sector, meaning collectively all those businesses that produce technology tools, services, and products, comprises just 7% of gross domestic product. So they're 7% of the economy, but 30% of the market. Conversely, the largest sector in the economy is healthcare. And by the way, 80% of healthcare are healthcare services. Only 12% of the United States stock market, however, is in the healthcare sector, with about half of that focused on drugs and devices. So in order to get exposure to the healthcare services sector, you very much have to look well below the hood of the top 85 companies for the most part. Similarly, when we think about growth, those media channels that have exploded over the last 30 years tend to get excited, and the conversation gets heated. And there's a lot of sharing of articles and communication about fast-growing companies. Well, if you take a look back over the last 25 years and ask, how fast have companies actually grown? Well, you might be surprised to learn that the average earnings per share growth for the S&P 500 over the last 25 years has been 3.2% per year, roughly similar to the growth in the United States economy, as you would expect. Today, in the S&P 500, there are only 295 companies that are still in the index that were also in the index 25 years ago. And most of the companies that are no longer in the index either merged, failed, or they no longer met the criteria for inclusion, meaning they probably grew substantially slower than that 3.2%. So even though we're looking at the successful remaining companies and their growth rates, it's still instructive. If I look at the high growth companies, meaning companies that have grown by 15% per year in terms of their earnings per share over a 25-year period of time, there are only 37 or 12% of the S&P 500. If I hung my hat on those bets, what I'm really saying is I believe in the low probability bets. Maybe there'll be big winners, but only 12% grow at those very high rates. Conversely, if I look at the very slow growing, well, maybe we won't make the reward that we need, and as Carin and Sebrina will discuss in their presentations. But you might be surprised to learn that, in fact, if I look at the middle of the road, companies that grew over a 25-year period of time on a sustained basis between 5% and 15%, it was more than half of the companies in the S&P 500. If I focus too heavily on the extremely high growth rates, I might get myself in trouble with low probability bets. On the other hand, if I look at that slow lane of very slow growing companies, maybe they're very inexpensive, but they may be on a road to failure. And it may be even more surprising that if we maintain our gaze in the middle of the pack as we do, in fact, those are the highest probability bets in the stock market where the majority of companies traded live. So let me leave you with this framing. And I'm going to turn the discussion over to Reed McCoy, who's going to focus now have a laser-like focus on those high growth, high expectation, fast lane parts of the market.
Great, thanks, Brian. In his 2008 letter to shareholders, Warren Buffett quoted a lesson he learned from Benjamin Graham. Price is what you pay, value is what you get. The point being that an intelligent long-term investor should spend more time thinking about the value of an asset than constantly worrying what people are paying for it. At GHP, we believe that an asset should not be bought or held if its price greatly exceeds its value, or as the case may be, when no reliable way of determining its value exists. Assets that fall into these categories are too speculative for us and represent what we are calling the fast lane. What causes a large divergence between price and value is almost always fear or enthusiasm, causing impulses to override reason or common sense. When shopping, we call these impulse purchases because we know that we bought something we probably wouldn't have if we had stopped to think about it. Impulse purchases can be pretty harmless during normal times when self-control is fairly easy, but when times aren't normal, the absurd quickly overrules the rational. I'm sure someone out there who has a stockpile of toilet paper rolls bought before the pandemic or during the lockdown of the pandemic would agree with me. Impulse purchases happen in investment markets too and follow similar patterns, though the stakes are higher. As Mike's fourth quarter newsletter pointed out, undisciplined investors instinctually buy and sell for reasons that have nothing to do with a fundamental change in value. Simply knowing that fact is not enough to change investor behavior, and this cycle will not change as long as we still have those human instincts. To regulate those impulses day in, day out, we have to build habits and reliable systems based on years of investing experience. At GHP, our benchmarking system and quantitative approach to analyzing risk keeps us focused on value instead of being distracted by price volatility. We determine the value of our investments based on measurable and established streams of income. We use math and logic, not feelings, to determine whether or not there's any price worth paying, and if so, what is a reasonable price. This discipline is always important, but especially so given the unique set of conditions presented by the pandemic that have led to high-risk investments attracting impulse purchasers at record levels. Cryptocurrencies, initial public offerings, and some individual companies and sectors of the market have experienced skyrocketing growth in the past 12 months. The speed and magnitude of which amplifies the fear of missing out or the fear of unwillingly being forced to take on more risk. By briefly addressing a few examples in each category today, we hope to relieve some of those fears. Though there are many nuances and variations of cryptocurrencies, the questions we primarily receive relate to ones that are decentralized, meaning they are not currently regulated by the government, and there is no physical place to exchange them like a bank.
These decentralized currencies represent a fast lane asset in its purest form, a wildly volatile price and an indeterminable value. Buying a Bitcoin, for example, is like buying a raffle ticket when the prize is a cardboard box that is just as likely to be empty as it is to have any amount of money in it. To be a Bitcoin investor is to be comfortable with that level of risk. For those who buy Bitcoin because they are believers rather than just speculators, meaning they believe it will replace or become a dominant currency for everyday transactions, an argument for its current value is often based on its unregulated nature, while the argument for its future value is based on it becoming widely accepted and useful for legal transactions, which would require some level of regulation. This is just one paradox that can make one's head spin when searching for the value of Bitcoin. And it's not meant to close the debate on decentralized currencies writ large. However, it illustrates the point that when a logical search for value fails the common sense test, and there's no basis for a mathematical valuation like established income stream, all that's left is speculation and debate. The decision to place Bitcoin in the fast lane and keep it out of our clients' portfolios until value is determinable is one we make with a high level of confidence. In the third and fourth quarters of 2020, while Bitcoin was attracting so much capital, an unprecedented number of private companies took advantage of the market's appetite for high-risk investments and went public. 2020 ended up being a record year for these initial public offerings, or IPOs, with almost 500 companies going public that raised a total of $174 billion. That's a 150% increase from 2019, which was higher than each of the prior 4 years. Half of these IPOs happened by way of special purpose acquisition companies, or SPACs. These are known as blank check holding companies that go public with the sole purpose of using the capital raised to acquire a private company. If you're thinking a blank check sounds an awful lot like buying a raffle ticket with a mystery prize, you would be correct. Only this time, the contents of the box are still unknown, but the cardboard box has the face of a very intelligent looking investment manager on it who promises to fill that box with something of value. The mechanical difference between a SPAC and a traditional IPO are of less importance to us than the fact that the information available is too limited to apply our methods of risk analysis and valuation. Using our profit stability score explained in the video at the start of this presentation as an example, we ideally want 10 years of financial information to rely on that metric. In the case of IPOs, we wouldn't even have 3 or 5 year data. So while venture capitalists take large bets on IPOs and may be rewarded for doing so, we feel comfortable steering clear of them until more reliable information is available. This surge in IPOs in the second half of 2020 came more than a year after large cap tech stocks had already began drifting into the fast lane. The NASDAQ 100 index, shown on this chart, holds a basket of large non-financial companies. Many of the companies are growth-oriented and in the tech sector. As highlighted in the chart, the divergence in large cap tech between earnings and price had already begun in 2019. This was only exacerbated as investors looked to these companies with reputations of innovating and adapting to a changing world for comfort during uncertainty of the pandemic. It's not surprising that these products and names hold a special appeal for investors who are hopeful that technologies like electric vehicles or green energy will help avert the next crisis, or that video conferencing will replace in-person meetings. But buying a company is not the same as buying an electric vehicle, software, or solar panel that it produces. Investors who require a return need to be careful not to inflate their estimates of value based on product popularity, nor to buy companies who make desirable products but have poor business models. High-risk investments will always have a place in the market for speculative investors, and we sincerely hope that no harm comes to the speedsters in that lane. It is simply not our chosen approach. Our mandate is to preserve our clients' wealth, and we believe that this is achievable without being swept up or left behind by those in the fast lane. Although our radar gun is clocking more speed limit violations, the conditions we're faced with today are not raising the same level of alarm as the dot-com bubble or financial crisis. So we will continue to keep our focus on buying and holding good businesses, avoiding impulse purchases, and keeping a watchful eye on fundamental shifts that threaten the wealth of our clients. With that, I want to hop over a few lanes to Carin to discuss the slow lane.
Thanks, Reed. When you think about the tortoise and the hare, usually you think if you are slow and steady, you'll eventually reach your goal. Well, that's not necessarily the case for investing in the slow lane, bonds. Think about it this way. Just because you are in the slow lane doesn't mean you won't get into an accident. While there is the perception you can't lose money in fixed income, actually there are 6 bond risks that can lead to losses. And sometimes those losses can be significant. Today, I'm going to talk about the 3 losses that we're most concerned about at GHPIA as it relates to fixed income. But before I talk about the losses, I want to make sure we're on the same page. Fixed income, otherwise known as bonds, is when investors lend money to the government or to a corporation. I like to think of them as an IOU between the lender and the borrower with a determined interest rate and a payback period. So on to the risks. The first risk is credit risk. That's the risk that an issuer may not be able to make future payments. Prior to the pandemic, we had almost all of our bond allocations in short-term bond funds. When it became clear that we were going to shut down both the US and global economy, we realized that corporations that were borrowing for short periods of time may not be able to meet their debt obligations, so we sold those funds. Luckily, at the time, we were able to buy 1-year CDs yielding around 1.25 to 1.5%. But unfortunately, those CDs are maturing and new CDs are yielding much less. In addition to credit risk, we're also concerned about inflation risk. That's the risk that your investment will be worth less in the future. So if you look at the chart on your screen, what you'll see is you'll see the yields of both the 5-year treasury, that's in gold, and the 10-year treasury, which is in blue, since 2003, and these yields are after inflation. For reference, the black line is 0%. So what it's showing you is that over the last decade, the real yield for treasuries has had a period of being negative, including right now. So investors are almost guaranteed that if they lend money to the government for 5 or 10 years, there's going to be an economic loss. So the next logical question is, if treasury yields are so low, what about corporate bonds? This chart's going to help answer that question. What it's doing is it's showing the yields of the 10-year treasury, that's in the maroon, or I guess in red and bold, and that's considered the risk-free rate. And we're comparing it to corporate bonds from AAA, that's in gray, to junk bonds, which are in teal, from 2006 all the way to right now. And it's highlighting that we're in a historically low interest rate environment. So that's the third risk, interest rate risk. That's the risk that as interest rates rise, bond prices could fall. As an example, let's say that you bought an investment grade bond today yielding 2%, and yields on those same bonds increased to 4%. In order to buy the higher yielding bond, you would have to sell your bond fund, or your bond, not fund, most likely at a loss. Looking back at the chart, in 1996, a 10-year treasury was yielding over 6%, and today that same treasury is only yielding 1.6%. So back during the 90s, when interest rates were higher across the board, we allocated more of our portfolios to bonds. Throughout this 24-year period, the spreads between treasuries and corporate bonds at times have been higher. During the internet bubble in the early 2000s, you could earn 4.5% over the treasury yields by buying junk bonds. And that spread increased during the financial crisis, rightfully so, to over 7%. Now the difference between the 10-year treasury and junk bonds is only 3.88%. That's not very much compensation for the potential of the bond defaulting. And even if you compare that to the AAA rated bond, that's only 0.98% more than the treasury. So since we believe that all 3 of these risks, credit risk, inflation risk, interest rate risk, still exist in the bond market, we now have much of our fixed income allocation in cash, just waiting for interest rates to rise. To us, it's obvious that the slow lane is experiencing a traffic jam. Now Sebrina is going to explain why we won't use the shoulder to pass.
Sorry about that. I couldn't get my.
Oh, sorry.
I couldn't get my mute off for a moment there. I apologize for that. So, like Carin said, we're going to focus on the wreckage. We joked that the title for my presentation should actually be Debt, Dilution, and Destruction. Please keep those words in mind as we go through. On any road trip, it is important to avoid wreckage on the side of the road, and 2020 held a lot of wreckage on the investment highway. Bankruptcy filings for public companies reached the highest level since the 2008 economic crisis, and many companies are still struggling to stay afloat amid continued capacity restrictions and constrained demand. One measure of risk we consider when we analyze stocks is the debt level. Businesses carrying high fixed costs as well as high debt are particularly exposed to liquidity risk. Going into the pandemic, most public companies actually had reasonable debt levels, suggesting an ability to endure drops in cash flow. But several industries entered 2020 too heavily indebted, and the pandemic pushed a number of those companies off the road. So let's explore what happened in a few of those industries: oil and gas, movie theaters, airlines, and retail. Even before the pandemic, a few oil industry analysts were anticipating that 2020 would be the year of oil bankruptcies. The US shale boom pushed American drillers to borrow heavily to finance their drilling. In the early weeks of the pandemic, when global society stayed home, energy demand plummeted. In addition, Saudi Arabia and Russia fought for larger shares of the dwindling global market, sending oil prices tumbling. On April 20th, 2020, for the first time in history, oil prices traded negative, falling to a minus 37.63, as traders feared that US crude oil storage would become completely filled. When the dust cleared, the pandemic had destroyed a fifth of global fuel demand last year. Over the longer term, government policies around the world to reduce greenhouse gas pollution could further reduce oil demand, putting pressure on the entire energy sector in years to come. As an avid movie fan, movie theater restrictions were difficult for me in 2020. The closures and restricted reopenings exposed significant risks to ongoing operations in the industry. Already under pressure from home viewing and high fixed costs with variable income, movie theaters were an obvious victim of the pandemic. For AMC movie theaters, which operates 620 theaters in the United States and 358 in Europe, revenue decreased from $5.4 billion in 2019 to $1.2 billion in 2020. Theaters were closed for months and are still reopening at reduced capacity. The third quarter 2020 earnings report revealed that AMC was within just a few months of burning through its cash reserves. However, since December, AMC raised nearly $911 million of additional capital through the issuance of additional shares of common stock and debt. Even so, estimates suggest that without significant increase in attendance, liquidity extends only through late summer 2021. Though restrictions may be lifting across the globe, delays in production by major Hollywood studios will continue to challenge their operations through 2021. The increased debt and dilution of shareholder investments suggests that the industry will continue to struggle. I'm really hoping to return to theaters soon, but I am not in a hurry to invest. Airlines are similar. They have a tendency towards high fixed costs, but 2020 saw a dramatic change in operations due to severe travel restrictions across the world. The International Air Transport Association cited a 75.6% drop in international travel in 2020. The forecast for 2021 is better, but still remains only slightly above half the levels of 2019. While restrictions have started to lift, analysts estimate that the airline industry will see worldwide losses of $38 billion in 2021, following losses totaling $118 billion in 2020. Norwegian Airlines reported a 79% decrease in revenue in 2020 compared to 2019. Net income was reported at a negative $183 million in 2019 and dropped to a loss of $2.4 billion in 2020. The carrier again was already struggling before the pandemic, resulting from its aggressive push into low-cost long-haul market. Norwegian filed for bankruptcy in November of 2020 and filed a restructuring plan in January of 2021 that will see them focused on shorter European flights. Closer to home, and similarly, United Airlines saw a drop in revenue from $43 billion in 2019 to $15 billion in 2020. Total debt of $20 billion in 2019 rose to $33 billion in 2020. United announced plans to raise $9 billion in loans and bonds. The company stated in March 2021 that it saw a forward acceleration in customer demand for travel and new bookings, and it expects positive daily cash flow moving forward. However, high leverage, and an uncertain recovery timeline still make this too risky. In retail, 2020 saw 30 large brick and mortar retailers filing for bankruptcy, including names you'll know like JCPenney's, Neiman Marcus, the parent companies of Ann Taylor and Men's Warehouse. Again, high levels of debt meant those bankruptcies did not surprise those of us watching the financials of these companies over the years. What happened to all 4 of these companies or industries in 2020 is why we are always keeping an eye out for financial risks, such as excessive debt. Investors need to watch out for debt, dilution, and destruction so they don't follow overly leveraged companies into the ditch. Now Mike is going to steer us back away from the investment highway wreckage.
Thanks, Sebrina. In wrapping up this portion of our presentation today, I wanted to address one of the more frequent questions we've been fielding from clients lately, which is whether the stock market has rallied too far and is now the time to sell or heavily reduce our equity exposure. And it's a reasonable question, considering US stock prices have more than doubled in the last 5 years, despite numerous episodes of gut-wrenching volatility. With this fantastic rally for stock prices, along with a collapse in stock earnings during the pandemic lockdowns last year, valuations have risen to lofty levels, last seen just before the dot-com bubble burst and ensuing stock prices collapsed. So the valuations risk question is not lost on us. To add to the trepidation, we now have proposals for raising corporate, estate, and personal tax rates, and long slumbering inflation seems at risk of reawakening with a vengeance. And yet, in evaluating these risk factors, our advice remains that our portfolios stay tilted towards equities. Although we do not want to shift into the fast lane, Reed summarized, with signs of bubbles and excess mounting, we also do not want to make wholesale reductions of our equity portfolios, thereby shifting into Carin's slow lane, where bond yields after inflation equal a losing proposition. Further, while we've made a few adjustments to our equity portfolios at the margins during this pandemic, we are not inclined to risk our investments into the highly distressed sectors Sebrina highlighted, as balance sheet weakness in these sectors will extend for several years. The good news is the middle lane equity markets remain attractive for the following factors: primarily the nascent economic recovery and the corporate earnings rebound. With regards to the economic recovery, I want to highlight the Fed, fiscal stimulus, and the consumer. Fed monetary policy has been very accommodative over the past 15 months, and they have been clear. They aim to keep financial conditions loose for this year. Interest rates are set to remain near all-time lows. Recently updated Fed guidance is for just 1 rate increase in 2022, up from today's level of 0.1%, and possibly 2 increases in 2023. And so far, the Fed is not deviating from this guidance in response to yesterday's market-rattling monthly inflation data. The Fed's announcement in late April also reinforced continued monetary stimulus for the credit markets of roughly $160 billion per month until substantial further progress has been made toward maximum employment and price stability. Fiscal stimulus and deficit spending have been at record levels, which has created a good news, bad news situation. Ultimately, as seen in these first 2 charts, aggressive Fed monetary policy, along with record levels of fiscal stimulus, have supported a swift economic rebound to this point when compared to prior recessions, such that we may even recover pre-pandemic GDP levels by this summer, while also enjoying economic growth surpassing many other wealthy countries. And in the second half of this year, we will likely get a massive economic boost from the good old American consumer, as personal savings rates and private income levels have been soaring during this pandemic. For example, personal savings rates have more than doubled since the pandemic began. US consumers have accumulated over $2.5 trillion in surplus savings, which will unleash a spending boom as we continue to reopen. With regards to the corporate earnings rebound, I want to touch on stock valuations, corporate cash, and a recent market leadership shift. The market just enjoyed a first quarter 2021 stock earnings recovery of over 40% year over year. You can see that as the last green bar in this chart before we get to the estimates for subsequent quarters. The quarter that we just wrapped up was quite lovely with regards to earnings rebound. And corporate guidance suggests second quarter earnings growth will eclipse 30%. Corporate America remains very upbeat with guidance for continued earnings growth through 2021 and 2022. Such robust earnings growth has already begun to moderate elevated valuations. And importantly, even if valuations were to remain high, persistently low interest rates engender our higher tolerance for stock valuations at above average levels. Similar to the US consumer, corporate cash sits at all-time highs. For example, when accounting for non-financial companies in the S&P 500, swelling cash levels have recently surpassed $2 trillion, which is up threefold from the years preceding the financial crisis. And finally, the stock market has more recently enjoyed a broader sector rebound. In the first quarter, value stock outperformance of growth stocks was the biggest in 20 years. In other words, no longer are we only enjoying a narrow tech sector stock market rebound. With all of these tailwinds, although we may prune back some of our stock portfolio growth and take marginal gains from some of your stock allocations, our overall advice is to remain in our middle lane and keep riding this pandemic recovery. Thanks for your attention during the panel delivery today. Now we've fielded some questions from you, and Brian will send them out to the panelists for the question and answer portion, which if you're watching your time to get back to work or what have you, we expect this piece to take about 20 minutes. Thank you.
Thanks, Mike. Thanks, everybody. One of the things that I dislike about the Zoom webinar formats is it's much more difficult to have interactivity. And I very much, and I think we all look forward to having that again when we are back both live and simulcasting these video presentations. We had asked for all of you to send in questions, which many of you did. And so what we did is we organized responses to the four most common questions. The first question concerns federal government debt. Second, cryptocurrency. Third, inflation. And fourth, the Biden tax proposals. Excuse me. So I'm going to first ask Carin to perhaps walk us through our views about the escalating debt situation in the United States and what risks that poses for us as investors.
Great, thanks, Brian. Not surprising that debt's the #1 question. If you look at the chart that Brian just put up, what it's highlighting is it's highlighting US debt held by the public relative to GDP from 1929 all the way through the end of 2020. And if you look at it pretty closely, you can see there are two periods that stand out. The end of World War II, when debt relative to GDP was about 120%. And now, while they're not exactly the same debt level at the moment, maybe by the end of the year, we may even exceed the debt level that we had at the end of World War II. If you look just to frame the problem at the chart below, it's showing the government interest expense as a percentage of GDP. At the end of World War II, the interest expense didn't exceed 2%. And that's where we are now, where our debt relative to, or that interest expense as a percentage of GDP is not exceeding 2%. However, the reason why we have such low interest expense is because of the low interest rates that I talked about in the slow lane, when you have the 10-year treasury yielding only 1.6%. So even if interest rates don't increase significantly in terms of servicing the debt, a 1% increase from where we were in terms of our interest expense last year is 100% increase in the terms of servicing the debt. So how are we going to tackle the debt? There are going to be 4 ways that we're going to handle the debt when it gets too onerous. The first is we're going to have economic growth. The second factor is going to be a combination of higher inflation and economic growth. Most likely we'll have higher taxes, and we'll also have reduced government spending. To frame or to really explain this problem, though, the last time our interest expense exceeded 3% of GDP was in the 1980s and the 1990s, and you can see where the bubble skyrockets. And those were good economic times. So just remember that high interest expense doesn't necessarily mean that we're going to have an economic crisis.
Thanks, Carin. The only thing I might add, if you don't mind, to your comments is in the 1980s, interest rates were double digits. In fact, they peaked in the early 80s in the neighborhood of 18, 19%. So even though the debt level was at its low, the interest rate was so high that the debt burden in the 1980s was actually higher, as Carin just said, than even during World War II. It seems unlikely to us that interest rates will get back to those very high levels, but it's important to remember that every percentage point increase today is the equivalent to 3 percentage points in the 80s. So smaller increases in the interest rate will have a magnified impact. And it seems to us that there is a bit of a limit at this 3% level where society begins to change and shift its attitudes. Because at that point, almost all economic growth will go to service the debt. And that's what happened in the 80s. And we shifted away from those debt escalation policies in the late 80s and 90s towards surplus. I believe there are limits. We believe there are limits, but we are not anywhere near those limits at the moment. So we're in this phase of debt escalation for a little while. Let me now turn to Reed, because the second most common question that we received from all of you concerned cryptocurrency, and Reed discussed that briefly in his remarks. I just want to tie it for a minute back to some of the original comments I made. I mentioned that the United States stock market is worth $112 trillion, the world stock market, $112 trillion. Well, guess what? Bonds in the world are worth $120 trillion. The total amount of money in circulation is about $90 trillion in the world today. Bank loans globally worth $80 trillion. All of those assets in the hundreds of trillions priced in national currencies. If I compare that to cryptocurrency, which is now worth collectively $2 trillion, it really is a very, I hope that gives you a sense of how small the phenomenon is, despite the conversation that it generates in the media. Reed, let me turn it over to you just for a little more elaboration.
Sure. Yeah, I think it's important that when I was in my presentation to narrow the discussion, talk about some of the bigger, more popular cryptocurrencies like Bitcoin, Ethereum, Dogecoin are all getting a lot of popularity, a lot of attention. But the one thing that I think is very important is to distinguish between a cryptocurrency that we commonly refer to it that way, and it is a decentralized, that is the very kind of where it derives its value, is the very fact that it is more secret and not regulated by a government, versus what is becoming more and more a part of the public conversation, which is digital currencies that maybe are adopted by a centralized government. I explain that because I think it's important to not throw out the baby with the bathwater. Just because we don't believe that, and I cannot find to our best efforts anything to really hang our hat on for a valuation of something like Bitcoin, there is certainly a lot of technology and hopeful advances that will come from this entire exercise, whether that's looking at the blockchain technology, smart contracts. There's all sorts of things that are part of the conversation now, but they really have nothing to do with looking at a coin as an investment. And if we really have nothing mathematical to hang our hat on, then all we can look at are the strengths, weaknesses. Basically, we have to throw our coins in, excuse the pun, but we have to throw our coins in the wishing well and just hope for the best. There's really no nothing that we can hang our hat on except for our excitement. And I can tell you, as kind of the very excited millennial here asked to talk about the fast lane, I love learning about this stuff. My intellectual curiosity is piqued by it. I also hear and have many friends that like it for like some of these cryptocurrencies for the very reason that they send the message that they're upset with the current state of the financial system or the government regulation. I know that's happening in other countries as well that are trying to adopt these things as kind of a dissent to the current government. So there's all sorts of things and reasons that are very fascinating, but I bring it back to the point that just as an investment, there's none of these that are apparent to us that there's going to be a clear winner. And everything is just so much of a gamble at this point that it's great to pay attention to, but it's really not something I'm going to keep my coins out of the well and put them in the piggy bank.
And Reed, I appreciate you gave that answer without any reference to Elon Musk and Saturday Night Live.
And I'm not bringing up the meme of the dog in Dogecoin.
Right.
That was the genesis of the thing.
The third most common question we received, although I think had we asked for questions yesterday, it would have been number one, is inflation. Of course, we got a report where inflation year over year was above 4%. So Mike, let me turn it over to you to discuss some of the short-term, long-term implications of and our views about inflation.
Sure, thanks, Brian. I think we're pretty good on time. So I might elaborate on this to unpack as it became quite relevant yesterday in the markets. The markets up until the rally midday today were down about 4% for the week, and mainly due to inflation concerns. So to Brian's point, yesterday, the consumer price index was released with the so-called headline inflation up 4.2%, which was the highest inflation reading in over a decade. So that rattled the markets. Headline inflation includes more volatile food and energy prices. The core inflation, which strips that out, and the Fed is watching a little more closely, was only up 3%. Most importantly, though, when Brian mentioned year over year, we think about the base year in this case, the denominator, if you will. This was April of 2020 into April of 2021. What were we all doing in April of 2020? Well, we were sitting at home in pajamas, putting puzzles together and playing Monopoly. So obviously there's going to be an increase in prices as we're coming out of this pandemic and vaccinations, et cetera. If we try to normalize the numbers, all of this is so necessary because this is one of the strangest recessions on historical record. So let's go to 2019 and normalize on a 2-year period, and the inflation rate is only 2% when you go back to that base, which creates a far more pedestrian result and nothing to get alarmed over. But to Brian's question about the cross currents of what is temporary inflation and what is permanent, I want to unpack that a little further. I also want to talk about Fed monetary policy. All roads so often lead back to the Fed and central banking across the world, and then stocks as an inflation hedge. So with regards to temporary versus permanent inflation, it is so necessary. And the Fed has been critical on this. Instead of temporary, they use the term transitory. But let's think about reduced capacity and increased demand. So here, very simply, hospitality, travel, used cars. During the pandemic, lockdowns reduced capacity of these types of things. And now all of a sudden you're getting this increased demand. For example, over the weekend, we had the highest volume through airports in the United States during the pandemic. And that number is only going to go exceedingly higher as we get through the rest of the year. Rental or used car sales went way up in the report because people first are still reluctant to use public transportation, but also we've got the second big temporary issue, which is supply chain snarls. In this case, semiconductor shortages have factories like Ford and Chevy not producing cars. So folks are buying used cars in higher demand because there's a shortage of supply because of the semiconductor supply chain snarl. In addition, you got things like the Suez Canal. Obviously, we all saw that ship stuck a few months ago. You got freezing temperatures in Texas, shutting down refineries. Pipelines this week now getting shut down for ransomware, which really spiked gas prices. So you got all these supply chain snarls, and you've got to kind of unpack that before we get, really concerned about the increase in prices. But that's met also with this temporary increase in demand as we're all heading back out to normal life again. But what's most fascinating to me, and I think really for the next decade or maybe my entire career, is this paradigm shift to permanent inflation increases from the last 20 years. Most importantly, and I'll just be brief on this, with baby boomers leaving the workforce in the United States, and numbers out of China, for what we can believe, numbers out of China showing a decrease in the working age population, that they've hit a peak in working age population. That, to many economists, and I myself included, signals the end of this 40-year era of globalization where labor costs went down. And instead you have fewer workers in the workforce. And therefore, we may be on the cusp over a decade, again, in long waves, of increase in inflation because of higher wages for those fewer workers in the workforce. So that's a permanent theme that we're watching closely. And then, like what Carin said, obviously the more permanent theme that has been incredibly bigger during the pandemic, but even before the pandemic, is the increase in government debt, not just here, but globally, increase in government debt. And that leads me to the Fed monetary policy. The Fed is fully aware that the last decade they were fighting disinflation, where they couldn't get inflation up above 2% for really the entire post-financial crisis era. And then when they had rate increases, it had a pretty pernicious impact on the markets. They were premature increases, it seems. And so their grand experiment right now is to let inflation run hot, meaning they're going to go over the 2% target before they raise rates. They don't want to be in trouble of raising rates prematurely like they did pre-pandemic. I think it's one of the harder jobs in America right now. It's so challenging, again, because of how strange this recession is. But they're trying to buck that trend of disinflation from the last decade. Then you got 8 million people who are still out of the workforce that had their jobs before the pandemic. Of course, there's all the distortions potentially from the unemployment benefit extensions. 9 states have already said we're not doing that anymore. But the labor report last week was a total head scratcher because possibly there's distortions due to that extra unemployment benefit. But the Fed says we've got 8 million people still out of work. So we're going to leave rates low for longer. And to Brian's point, the magnification of raising interest rates, I think, has far-reaching implications. Just to walk that out a little further, if you come from 4% interest rates to 5%, that's a 25% increase in the rate. If you go from 1% to 2%, that's a 100% increase. So it's definitely going to amplify and potentially give the Fed a little more wiggle room to tamp down inflation when it becomes more permanent instead of just temporary. And finally, I'll say that stocks as an inflation hedge is important to remember. In the short run, stocks will be volatile, like we saw yesterday. We had a 2% sell-off in the market with these numbers. And so I would expect lots of volatility as the market and consumers keep unpacking inflation issues and price increases over the course of the summer and into the fall, et cetera. But remember that long-term stocks act as a prudent inflation hedge. And then, to echo Brian's point from earlier, diversification of a stock portfolio is so critical. Growth or tech stocks do not perform as well historically when inflation rears up and interest rates are rising, whereas value stocks like financials, banks, industrials, energy tend to perform better. So diversification is critical. GHPIA has been proactive in this regard by patiently maintaining a split between growth and value stocks. And In my opinion, inflation is the most pivotal factor for the financial markets in the pandemic. And we'll be paying close attention to the data to parse out temporary inflation from permanent price increases in the year and many years ahead.
Yeah, Mike, in fact, just to add one brief comment to what you've just said, which I completely agree with, and to bring it to that much bigger picture historical point of view. The 1970s, when we had rapidly escalating inflation and culminating with those double-digit interest rates in the 1980s, it wasn't just because of rapidly rising money supply, although that also was the case, but productivity in the US economy was at a historical low. In fact, as we got to the early to mid 1970s, we reached the lowest productivity growth in a century. And in my opinion, it's no accident that in 1976, Steve Jobs invented the personal computer, because that was the bottleneck. There was necessity is the mother of invention. And productivity growth from about 1876 through about 1966 was there was rapid productivity growth. And as we got into the late 60s and the maturation of the Industrial Revolution and into the 70s, productivity slowed very substantially. And as we entered the information age in the late 70s, early 80s, and especially starting in the 1990s, productivity growth accelerated again. And we are still in the very early phases of that information age transition, in our opinion. So it is true that we've had significant growth in money supply, but we do not have a commensurate reduction in productivity like we did in the 70s. So it seems to me, just to add to what you said, that there will be rising inflation and that there will be somewhat rising interest rates in response, but there are guardrails on the bowling lane for those numbers that weren't present the last time we got into an inflation cycle in the late 60s through the early 80s. Not that that's the definitive end all and be all. When we're in live, once again, you can feel free to debate or one-on-one, as is often the case. But let me turn it over to Sebrina. Because she's a CPA, we gave her responsibility for all the depressing topics, including the more recent Biden tax proposals. Sebrina, good luck.
Thank you. I am just celebrating the fact that I was able to unmute myself without panicking that time. So Biden's opening bid on tax law changes does seem to be triggering a lot of anxiety. But remember, what we're seeing is his proposals, and so not law yet. We still expect a lot of negotiation to come. I did go through and want to just give people a few things to keep in mind as they're hearing all of the news. While it's possible to enact tax law changes retroactively, retroactive changes tend to be very politically unpopular, particularly in relation to income taxation. We're very late in the game for 2021, and enacting the law in time for 2021 filings becomes increasingly unlikely, particularly again related to income tax filings. If you remember the last time that we had a significant change, one of the problems that you have is with withholdings and with the payroll providers trying to get those tables updated. So a change this year, still possible, but I feel like we're getting closer and closer to it being maybe an impossibility, if not an improbability. Biden has proposed an increase to the corporate tax rate up to 28%, which feels like a huge jump from the 21% we adopted under the Trump administration. But try to keep in mind that the highest corporate tax rate from 1994 to 2017 was 35%. Similarly, the proposed increase to capital gains tax to 39.6% is a huge jump up from the 20% number, but it would apply to investors with $1 million or more in annual income. When we're trading in your accounts, and one of the things that we do when we're reaching out to update your information is we're always trying to keep track of what your tax bracket is and what any tax impact is when we are making trading decisions. We've talked around the office that this capital gains rate may change again. So if we don't have to sell when there's a 39.6% impact possible, we may not do it at that point. However, coupled with the increased capital gain tax rate, investors are also hearing more and more about a potential to eliminate the step up in basis that is currently recognized at the death of an investor. As it stands, it appears that the proposal will be for an elimination of a step up in basis above $1 million of stepped up value. This is not the first time we have seen the step up basis under question. In 1976, the Tax Reform Act of 1976 would have eliminated the step up in basis completely, but the elimination was repealed before it could take effect. The Economic Growth and Tax Relief Reconciliation Act of 2001 repealed the estate tax and the step up basis, but only for 1 year. We also saw the Obama administration propose repealing the stepped up basis, which didn't come to fruition either. In relation to the estate tax exemption, as the law currently exists, each individual has a lifetime credit of about $11.7 million. And that current exemption is set to sunset on December 31st, 2025, returning it to about $5 million. Biden's proposal could mean a reduction to $3.5 million, but it would be the first time in history the estate tax exemption has been reduced. We plan for laws as they exist. So right now, we're not recommending large sweeping changes based on proposed laws that may never make it through Congress. Keep in mind that Congress is made up of people that are wealthy. They probably don't want to have a lot of these impact them either. However, we're constantly monitoring changes and we're always considering what the potential impact will be. So we will be in touch.
Sebrina, thank you. You didn't get into other things like the elimination of the 1031 exchange for real estate. There's lots of things that could impact, particularly business owners, people that own property, and they do seem quite draconian. So I think your historical perspective is well taken. In many, many cases, we've been there before. Not that we should go back, but we've lived through it before. We'll probably live through it again. Same with some of Carin's comments when it comes to the debt. People forget the 1980s, actually, we had a very high debt burden. We had high interest rates, high inflation. We lived through it. We prospered. We as a firm believe if we stay in this middle lane, as we've articulated, that it allows us to navigate many of these risks and pitfalls, many of which cannot be predicted from where we sit today. We want to thank you all for your business. We want to thank you for your partnership and your relationships with us over many years. We also wanted to take today's Zoom opportunity to introduce you to many of the people that you might have interacted with or maybe heard about and wondered who they are. So you could match their faces with their names and their roles, because we've grown thanks to you over the years, and it's allowed us to expand, as I said in the video, our expertise, our services, and our depth. We have quite a deep bench today, as I hope you were able to get a glimpse. I hope that next year we can see many of you at this forum in person, and we hope that later this year, we can see many of you in person in our offices. We are very happy that things are starting to open up, and we look forward to welcoming you in our new digs, as Mike said in our video. Thank you for your attention, and we look forward to discussing these issues and many others in the coming days, weeks, and months, and we hope that you have a wonderful rest of your day. Thanks for joining.